In this video, traders, we're going to look at a gap trading strategy for day traders. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this is not a video specifically about gaps. I've done another one of those. Go and check that out. This is purely a strategy, a systematic strategy that you can use as a day trader to trade these gaps. All right, so I just want to very quickly go over the two types of gaps. We've got a full gap and a partial gap. Called different things, but for this purpose, we'll use that terminology. A full gap, and this is a gap down scenario. We're just going to flip it for the reverse. A full gap is when we have a day one situation here, candle low. We know the kind of candlestick parameters and what they mean. The second day here is a gap completely under the low of the prior day. So there's just literally a gap in price. The low with gap right under it, and it's outside of the range. Now, a partial gap is different in that we close at a certain level and our open is below that level, but it's still within the range of the prior day. So you can imagine the day kind of did that. It was going down at a really deep low, pulled back a little bit, closed there. We're opening up still within the prior day's range, but we're below the low. So not quite as powerful from a bearish perspective, but something that we can still trade on anyway. Right, here are the rules for the trade. The first thing you need to look at actually, which is what I'm gonna really want to highlight here, is that the volume needs to be at least 2 times the 5 days. So you've got to have some kind of indication that this thing is really kicking off. Now, I know that during the day, it's difficult to judge this. So what you can do is, we're using an hour after the open here. What you can do is look at your hourly candlestick chart, and you can say, hey, how does this volume compare to the prior week? And you can either use an indicator for that, or you can eyeball it and say, hey, we're at a good intraday volume. The first hour, we've picked up a lot of volume, hopefully double what we normally do on average. Now, I know this is, we're kind of just eyeballing this and looking at it roughly, and you can code something up very easily that does this, but it's simply enough to say, hey, the volume's decent. And at the end of the day, that filter, guys, is just to make sure that there is participation in this market. All right, so that's the first kind of filter, if you like. You want to see participation. My suggestion is using a volume, but you can kind of adjust that how you want to. Right, so 1 hour after the open, so we leave the open, the gap has occurred. Obviously a full gap is going to be better for us, but a partial gap, this is still acceptable. And we can either, you can maybe do both and maybe adjust position size and go a little bit more aggressive on the full gap, or play it as you want. But here are the rules. 1 hour after the open, so we let the open happen, we let an hour chug along, whether we're trading the DAX or FTSE or the US markets or the Japanese markets, whatever it may be. Hour after the open, after we've had a good gap, we now enter on a sell stop. And by the way, for short, we can just flip it for the long. There's no point repeating myself, but you get the idea for the long side. We place a sell stop entry 2 ticks below the intraday low. So we wait for the first hour. So we've got the gap. Now we open up. We've done all the filters yet, ready to go. The first hour does whatever it needs to do. We then take that first hour, look at the low of that first hour, and place a sell stop entry short just a few ticks below. So in other words, we're going to get short if we break through that first hour low. Now, you may well just get a first hour that's trending down, in which case you need to say just get on board it, or perhaps you say, you know what, I want to wait for first pullback because I don't want to chase it. So you can add little extras into this, but really probably what's going to happen is you'll probably have a push lower, you'll pull back a little bit, hold, and then you want to get in on a break of that low because you've got volume, you've got the gap, and you've got a kind of a downtrending market. And the beauty of using the stop entry scenario is that if it's just a little bit of a flush at the open, it allows you to, it means you don't get in it. Because if it's a little bit of a flush, which you do get quite often, you get this gap down, a little bit of a flush, a little bit of a kind of exhaustion of the move, and then after the first hour, it pushes back up and fills the gap. It means that you're not getting sucked into that. You're waiting for the first hour, and you're saying, okay, well, if there's continued selling, I want to jump on board it. So you're entering the market 2 ticks, or again, adjust that to suit your style, but you want it just below that low, 6 ticks, 10 ticks, 20, whatever. 20 might be too far. Depends on the instrument you're trading, doesn't it, of course. Or another way of doing it is to use the open minus the low. So you're taking kind of the average of the two. So you take the open, you take the low, you take the midpoint, and you say, okay, there is my entry. So that's a little bit kind of a little bit of a flavor of getting involved in it, rather than waiting fully for the low to break. This gets you in a little bit earlier but hopefully still keeps you on board the right side. There's pros and cons to doing that, but it's just an idea and a flavor that you can perhaps add to it, adjust and tweak the plan. So really, let's recap. The theme is we're on a gap scenario and we want to see the gap to show that this is an extreme bullish scenario or extreme bearish scenario, bearish for this example. Once we've had that, we want to make sure that the volume on the follow through on the gap on the day is significant enough for us to get involved, because this is a momentum trade, don't forget, not a mean reversion. We're looking for a continuation of the move. So that's our filter with the volume. And again, we're just going to look on our hourly or 15 or whatever it may be and eyeball it, or we can come up with an indicator that does that for us. There are some pre-packaged ones, but eyeball is fine if we're day trading. We've already done the hard work and presented to us stocks or indices that have gapped. So that's done the hard work for us in terms of filtering and presenting the ideas to us. Waiting for an hour. After that hour is up, we're then going to sell on a break of the low if we're in the downtrend scenario, down gap scenario, or buy on a break of the uptrend scenario. And or we can have a little bit of a different flavor with it by using an average. Now, one thing I haven't talked about is stops. Now, what you can do with a stop is you can either say, listen, as it's a momentum trade, you could be, I feel personally, and you comment in the comment section below how you kind of want to trade this yourself. When I'm trading momentum, I prefer to be far more aggressive with my stops, because, you know, my whole thesis behind this is that, hey, we've got momentum, it's a catalyst momentum, you know, someone's lit the fuse on this and I want to be involved in it. I don't want to be so tight, obviously it's pinging me out, but then I don't want to let it come back too far, because the whole theory behind this is that it's triggering momentum. I want to ride that momentum. So, you know, my stop on this is probably going to be, you know, maybe above at the high of the day, depending if that's not too far. If the range is acceptable, just above the high of the day. I'm not going to start looking at this the first day here. I don't want to be having stops way above here, because to me, if the price starts pushing back into this level, it's a no go. Yes, there may still be a short later, but the momentum trade of following that gap isn't there anymore. So for me, the first hour, you know, I want to put a stop above the high. That's obviously going to be probably a day, but you get the point. It's looking at that first hour range and using that to frame the trade for you. And because it's momentum strategy, we don't want to give it too much room. Targets, you know, we're not going to go into that. That will be your analysis based on where this is on the broader time frame and where this is based on the kind of bigger feeling of where the market could go. Anyway, guys, that's a gap trading strategy, or one of them. There are several, but it's a good one to start with, and there's some ideas there for a foundation to tweak and adjust and fit into your trading plan. Hope it helps. See you in the next one. Take care. Bye-bye.